Hello, everyone. Welcome back to the RationalInvestor.com's Data Brief. Woo, party. Ah! Oh, man, what a day today's been. And mental note, let's all just take the day off when you get one of these big monthly employment reports. Oh, what a mess. I suppose, I don't know whether that's where we want to start our day, but we had the big jobs report for, I guess it was like December's jobs report. But that's actually not the one I wanted to show you. Where's the one I wanted to show you? Econs tastes great. Econs, can't wait. Here we go. So today was dominated by news. U.S. economy adds more jobs than expected in December. But at the same time, too, a whole bunch of sort of internal measures showing that like the service sector shrank. And probably more importantly, for those people who are watching the Fed really closely, things like the inflationary pressures about wages and stuff abated a bit. And everybody was worried the other day about the big jobs numbers. I think it was like a private, I think it was like the ADP report or something like that came out with a big increase in jobs. And of course, everybody was worried about the Fed. And when we had the Fed minutes there the other day, when Murat was on the show, you saw how the market melted down following the Fed minutes release. And ironically enough, all we're done is we're just right back to exactly that level. So very volatile, huge up day here so far. Dow's up 600 big points. We always say 2% change or greater should start getting fund managers' attention. So we're just kind of brushing up against the upper end of acceptable, but not like outright noteworthy price action, if that makes any sense at all. I think on balance, the market's catching a bit of a bid here. It's ironic that, it's not ironic. I mean, a couple of things. Number one, our opening range trades went flat for the day. Again, I think it's probably a good idea. And as Chris and I are sort of building this out, we'll probably talk more about this going forward, that the opening range trade, probably not a good idea to be taking those in front of the big employment report releases. Well, I suppose we can talk about that in a bit. Interesting, following that event, actually, we had a really interesting short setup that Shartoshi walked us through. I was able to ride on his coattails and take a couple bucks from the market for my account here this morning. On that, this is my sim account, just practicing. And then following sort of the retail open, market surged higher on actually a few econs that did come out. And it's kind of interesting because some econs are coming out right now, absolute train wreck, but they're not American. And that's the kind of weird thing, is that, I don't know whether it's weird, but this is exactly what I had sort of forecasted to have happen. It was just a question of when. We had the Canadian economy was rolling over anyway. You can see the M's prior to the COVID came out, and of course, all these silly governments and central banks all took interest rates to zero and just flooded the market with money. And so as a result, we got that weird 2-year kind of odd window where everything went just a little bit nuts. But Canadian manufacturing data, Purchasing Managers Index, the Ivy Index, which is sort of like, the Canadian economy, just absolutely collapsing here, 33.4. I mean, just even in the worst of the government shutdown, lock everything down, we're all going to hell in a handbasket, it was in the mid-20s. So here we are right back in the soup there in Canada. And I have talked about this a lot, although the sad part about it is Brian's usually right, but he's usually early. And somebody had mentioned, like I've been saying this all along, substitute drama teachers, terrible economics, just setting our country up for a disaster. We went through a massive hyperinflationary bout as the guy just was like spending money like a drunken whore and all full of sort of arrogance and confidence with his like little funny little showdown with Trump. And basically, I'm king and I can do whatever I want and go fuck you if you don't like it. And unfortunately, his runaway sort of communist government spending plan is now really punching Canada in the nose with the hyperinflation here. So put it all together, Canada's not doing so hot. The interesting thing is that the U.S. economy, I think, it is structurally in a much better place than Canada, and also too, a lot of the manufacturing and stuff that was sort of taken offshore following the dot-com boom, going through that whole fear cycle, it's basically coming back. And if it's not in Mexico proper, it is coming back even to the United States. The problem is for Canada is still way too expensive of a society here to justify any manufacturing in earnest. And if anything, the way that you solve that is with a weaker Canadian dollar. Anyway, we'll see how that goes. So point of the matter here is today we had quite a few econs, big numbers. And if we scroll through them, non-farm payrolls 223, market was looking for 220. That's basically in line. Probably more importantly, things like unemployment rate ticking up. I mean, this kind of stuff you would say that, the Fed's not going to really like that. Average hourly earnings, we're sort of getting back into that 2.2 to 0.3%. That's the window that they would like to see. So we are getting back down into that area, like when it was 1% or even 0.5%, like kind of like what the market was expecting. That's too hot. Average hourly earnings 4.6%. It is down ticking, so that's probably why the market likes it. Still 4.6. That is still too high. Participation rate kind of leveling off, and it'll probably bump along here as we make the transition from the baby boomers into the millennials. Average hours worked sort of in line, a little bit less, if anything. Manufacturing payrolls. This is interesting. So manufacturing jobs, not really stunning. Non-farm payrolls, private. I get the impression that it must be a lot of service sector jobs that are being filled. And interestingly enough, following the U.S. election and now transition to theoretically a right-wing controlled U.S. Congress, at least the House, we're probably going to see the U.S. government itself take a little bit of a back seat, if you will. So it is interesting to see, where a lot of sort of government jobs numbers and stuff padded for the election to try and help Mr. Biden's case there and the Democrats. And to a certain degree, I think it did help with things like the U.S. Senate vote, but interesting to see that the U.S. government now is sort of going turtle here. There's that Canadian Ivy number that we talked about, absolute train wreck. Interesting, the data following the employment report, and keep in mind, the employment report is highly, highly subject to revisions over time. And I wouldn't even be surprised if a lot of these data points are quote unquote revised going forward. So 7 a.m., we actually had some more economic data. And it's interesting, even though U.S. economy, like the actual jobs market, is fairly strong, the actual sort of underlying economic activity is still fairly weak. So non-manufacturing PMI, so this would be like all the service sector for all your senior citizens and stuff, healthcare, food services, dry cleaners, all that kind of stuff. Came in 49, so actually weaker. And this is basically what the market, what the Fed wants to see happen, is the economy is technically slowing down, but it's still a very, very strong job market down in the States. Non-manufacturing employment. So this is, again, this is all like the service sector, slight downticks, the market kind of probably like that. Now, this is the one that jumped out at me. I would have thought this would have had a material effect. Factory orders themselves, sort of big, and this kind of goes in line with the Ivy, this PMI, which is kind of like what's industry doing? These factory orders numbers, that's an absolute train wreck. So I'm still trying to, scratching my head trying to figure this out. You have literally two different directions. You have the jobs market because of the way that this, COVID world all got screwed up. Those jobs numbers are calming down, and that's a big chunk of the inflation problem. But at the same time, too, the economy itself is kind of petering out. And I don't really think it's the US economy that's really going to be in big trouble. I think it's going to be the global economy. And that's sort of the argument that I've made all along here is it's going to be the international story that's probably going to be under the most pressure going forward here, not the Americans. Anyway, point of the matter here is most of these econ numbers actually are showing a slowing economy. The good part about this is that the jobs numbers are just simply showing that the workers, there is a little bit of slowing going on here. And I think that was the headline that they were touting. U.S. economy adds more jobs than expected in December. So still a lot of job growth, but the biggest job gains occurred in leisure and hospitality, healthcare, construction, and social assistance. Interesting, social assistance would have an uptick. I suppose this is probably the biggest thing that's grabbed the market's attention. U.S. wages growth slowed more than expected. Now, that's all the econs that have come out today. And frankly speaking, like I said, they usually say, don't trust the jobs report because it's highly subject to revision. And we might find that next month, the whole darn thing is reversed lower. I am very interested. Those PMI numbers, they're pretty darn weak. So the economy is still shrinking. I think what happens here, this is the beginning of January. So what we really should be doing is listening to the market through this reporting period for things like the January barometer. And now, as you can see, we now have the first week of data in the books. I mean, I don't know where we're going to finish the day. My hunch is we're probably going to finish relatively near the top end of the range. It was interesting. Remember, Marat came on and did his presentation, and this was the remember the Fed minutes? I think that was here, or maybe the Fed minutes was here. Actually, yeah, maybe it was here. So right out of the gate, the market had a little bit of a bid, right? So there is the first opening bell. We had a bit of a bid. Then the market melted down. First day, a little bit of up, then a big wash down, then kind of a dead cat bounce coming out of the end of the day. If we project that now over the full week, and like I said, I'll sort of tweet this out and whatever I do with this stuff, near the end of business here today, I think you could make the argument, we're going to start off weak, probably going to have some sort of counter trend rally mid-year, interestingly enough, that I think probably is going to take a lot of people by surprise. And you can see they might actually even bring the market right back to basically where they started or even a bit up on the year. Then we're going to roll back on over and we're going to come back down and test these lows in earnest. And interesting how, I don't know who it was, I think it was Andrew had pointed out this morning that this is actually a perfect sort of Wyckoff distribution model, where this is your spring move right at the very end to wash out all the weekend shorts. Usually this move goes down below these lows, but nonetheless, and then on that employment report, the whole damn market just ratcheted higher here this morning. So to sort of finish the year, now I don't know where we're going to finish, but to finish the year, if we do go this kind of pattern, basically where we started, maybe even slightly higher. And actually, it was interesting in the lounge. Somebody says it looks like you're trying to upload SMT. I wonder what the hell that means. What's SMT mean? SMT. I don't know. If I go test, it seems to be working. Not quite sure what that is. Hafed's trying to keep me honest here. All right, I'll keep moving forward. I don't know what I've done wrong. If you can see something that's not right, let me know. Anyway, point here is last night, and actually I came back from Liam, and it was kind of cool. People pointed it out. Mr. Larry Williams had a new video that he was sharing with people overnight. And I did have a listen. I kind of noticed that he's kind of like, and I guess maybe he's getting a little bit more shilly. He's kind of like, I'm not going to tell you what's going to happen. You got to go buy my annual report. And you want to know what's going to happen? Go buy my annual report. You want to know what's going to happen? Go buy my annual report. The only issue there is I don't want to go and buy the guy's annual report and then start talking about it. I only like really doing this kind of stuff and then talking about this kind of stuff with you guys and in public videos and stuff. If it's free information that we're just, everybody in the public is privy to. So, oh darn. Anyway, I was kind of hoping I had that video handy, but I don't seem to have it. Anyway, if somebody does know that particular video, happen to have a link handy, if you could just dump it in the lounge, I'd appreciate it. But in essence, maybe Sharky's going to post it here. In essence, Mr. Williams was actually, and we'll probably talk more about this, some interesting screenshots that he had. I don't know whether I necessarily agree with his prognostication, but I do like the idea that 23, kind of like 2015 in crypto. And interesting enough, if you look at like a Bitcoin chart from 2015, it looks almost identical to this. I wouldn't be surprised if 23 kind of starts out really crappy, kind of bobs and weaves. We come back down maybe through this late summer into the fall. Things look like they're falling off a cliff, and then right into the end of the year, a surprising nice little counter trend rally pops up. That wouldn't surprise me at all. Anyway, so the point of all this is just, what should we be thinking in the market a la January barometer? And interestingly enough, I think there's a lot of correlation here. So US dollar index, if the market's not so happy, then we probably see, especially through the late summer and fall, we probably see the US dollar do really well. But then heading out of the fall and maybe into the early winter and into the end of the year, it looks like the US dollar is going to top out here. Bond market, now this surprised me, but I guess the point here is the bonds, they responded very positively to that jobs number. And like I said, I think it was interesting. Larry last night did sort of correlate an inflation sort of projection and the jobs, unemployment numbers down in the States, that kind of thing. And then it sort of suggested that maybe the push in the inflationary pressure will abate with all these interest rate increases, and so the jobs numbers should calm down. And that's, I guess, what you're seeing out of the bond market here. This should, if anything, help that yield curve inversion. The stronger that the long end of the curve is, the price is rising, the curve will flatten out. Maybe we'll talk about that a bit in the after video. As I said, there is the stock market's January barometer report. Interesting how basically we're now at unchanged for the year. I mean, it's been up and down like a horse drawers, but the end result is unchanged. Go figure. The gold market all over the place. Was quite surprised to see the substantial rally here today in the gold price. We are higher than where we started out the year, so I think that gold prices will sort of maintain their strong bid through 2023. And kind of like the study that we did on Newmont, I wouldn't be surprised if gold prices and gold stocks actually have a bit of a good time here for the next few years as we get over the COVID sickness sort of effects of the economy. More inflationary pressure. Crude prices, geez, just can't buy a friend here, but also interesting. Our whole thesis about gold prices moving higher, this actually works well in that thesis. Oil prices moving lower. Interesting how we do have a bit of a base forming here on the oil. So we'll watch that going forward. And then good old Bitcoin. Unfortunately, and I am running a trading plan right now, and it's a bit of an experiment, but nonetheless, I'm very confident in the platform. The only problem is, as you can see, the fast moving average of our crypto top 30 breadth indicator just crossed the slow. Boo, hiss, boo. So as a result, as I said a moment ago, I am just running purely a trading plan just based on these crosses. And I don't know what's going to happen, but we'll just see how we do. So on the 22nd of December, we had a bullish sign. So I just went and bought 0.1 BTC, and I'll use like say $1,600 or something like that as my base. And we just had the bearish cross, so I liquidated the position. You can see it was a difference of like $100. So I'm down a whopping 0.8% on the trade, but I'm just going to log and take every single signal, and let's see what the end result is at the end of the year. And if anything, I think this actually aligns nicely with what kind of like Julian's kind of thinking right now, where yeah, we did have a nice dead cat bounce and things are a bit firmer, but I don't know whether we're really in a new bull. And if anything, considering what we've got with the rest of January ahead of us, and then February, March, a little bit concerned about the long side of the market. Anyway, you can see Bitcoin did catch a bit of a bid here. You might also argue too, end of the first week. So this whole week's price action, what does this sort of tell us about the year to come? It looks like we're higher, actually, kind of like the gold market. And I did hear people talking about how they figure that Bitcoin and gold, in fact, there was, I don't know whether that George Gammon guy is worth listening to from a sort of economic perspective basis. I mean, sure, interesting videos to listen to. But I think his big prediction is that gold and Bitcoin will finish the year higher. So go figure. Having said that, there should be quite a bit of back and forth the whole way along here. So when I woke up this morning, in actual fact, I went to bed last night and I had this inside bar right at this trend line confluence. Pretty dramatic too, right? This was a channel that was actually just drawn off of these two highs. And then so that high and then this low projected that. And that gave me that sort of channel that I've been working with for the past little while. And then I had this potential trend line. It hasn't confirmed this big one. Boom, boom. It'll confirm on a move through up top here. But, potential nonetheless. Probably a lot of market participants were watching it. You can see market really sort of floundered and flirted with it. And then, just yesterday we came into this absolute incredible apex right at this trend channel. And then we broke down through this low. That technically is an inside bar reversal. That's a sell signal. It's not harami. Well, I mean, I personally don't like to call this harami. Classic Japanese candlesticks will say that as long as The body is within the previous body. It's okay. I would like to call this a bear rammy because part of the baby's body sticking out of mommy's body, but nonetheless, move through this low here, 16,755. That's a sell signal. So on top of the fact that we did get the cross, and I did this picture just so you could see, fast is at 70, slow is at 73. So the cross did come in. I also got this inside bar fail signal. So you could argue that the two of them together was compelling enough for me to step in there and pull the trigger, and I just covered the position. So we'll see what happens. Live by the sword, die by the sword. But the most important thing for me, just want to be a demonstrator of best practices. This particular model that I'm running, I'm just literally, as soon as the system flashes either a buy or sell, I'm putting the position or taking it off. Yeah, putting the position on or taking it off. It's just the way it goes. Let's see. Broader market, that employment report, I mean, it's had a material impact on the currency markets. And they always say as currencies go, so goes the rest of the market. I just don't know. I still think that within this January barometer reporting period, there's just a lot of volatility within the context of, like, I guess the Canadian dollar does have a W working here, which is fascinating, right? That PMI number is just a train wreck. So why on earth would the Canadian dollar be rallying in the face of that? And I don't think oil prices aren't really that strong. Aussie dollar catching a bit of a bid, and it's actually cool. One of our sort of OG day traders, he's following the Aussie dollar versus yen. When the Aussie dollar is catching a bid relative to the yen, that's a risk on vote. So interesting to see that working its way up. But all we've done is just rallied up against the top end of the trend channel here. I haven't really broken out. And the interesting thing with the Swiss franc, and this is a proxy on gold, is yep, we rallied back up into resistance, but that's about it. So I don't know what the end result, I mean, who does? What I would just simply say is, I think probably while we're still working our way through January, probably look at all this with a bit of a grain of salt. US dollar index, I think we heard Julian talking about how he's getting a little bit more bullish of late. I might argue that, and I don't know whether bullish is the right word, just maybe dead cat bounce-ish. As you can sort of see here, I like the idea of us just playing ping pong right now between the 38.2s to 50% and Feigenbaums. Isn't that incredible? God, is that usable information or what, eh? And now, really, we could even do the same study going the other direction now. So we can go boom, boom, and there's 38.2 right there. And the Feigenbaum, actually interesting how they're on both sides. So I don't know whether I necessarily believe that this is actually a breakdown. Maybe this is just the market got a little too far too fast. It ran into the channel resistance, and this channel was drawn off of this market structure top way up here, which I think looks valid. I don't think it looks unvalid. So there to there, and then dragged it back to the previous low, which is there. So what a surprise. Boom, boom, boom. Oh, wow. Let's go back to my room. So I might even argue that, probably for like first thing Monday morning, I probably want to keep an eye, especially, well, anyway, something like that. The juicy gaps, you can see the gaps. It's plain as day on this chart right down at the bottom, and notice that's 78.6. So, if I was a currency trading person, I might be inclined to keep a real close eye on how price acts, and maybe we'll watch it through the next coming week, how price acts down in this reload zone. And I actually think we'll probably have to go and fill that gap in there. So ironically enough, that's a big W, and I wouldn't be surprised if a lot of people did buy that. And really all we're doing is we're just checking the bottom end of the range here. We'll see how we act through here. If anything, if you do get a nice little W, this is probably a good place to, you could probably get a cheap trade, right? So there's your risk window and risk against that low there. So it gives you a relatively cheap trade. And, if you can think about, and you could do like the euro and the Canadian dollar and all that kind of stuff, exact opposite to this. I don't know whether you'd want to trade the index itself, but just things like moves back to 38.2. You see this big honking muak on the volume profile. I mean, that all needs to be filled in up there. There's the bottom of value. There's 2.618. So any kind of rally into there, you can see it's good 3-to-1 risk reward hunting some sort of pivot down here. So there is that. So I guess the way I'm thinking about it right now is probably the employment report just caught a lot of shorts off guard. And then two, if we're thinking January barometer, I think we want to think sort of back and forth through this reporting period. So again, I don't think this is the start of a new bull market, but they basically brought the market right back to where it was at the very beginning of this report. And I like the idea that this is what our year is going to look like. So, as a good example, and I don't know whether Bitcoin does the same sort of thing. It might. But as sort of an example, if we go and just pull up that Bitcoin, well, actually, we don't have to. Maybe I'll do that in the aftermarket report. Okay. So interesting how January barometers are still working away, kind of suggesting a flat year on balance. Do you find it interesting that the S&P 500 breadth is still pointing up, even though crypto is kind of waning? Remember, I like the idea of crypto as a leading indicator. So we'll see how crypto acts here. And I did notice that, yes, the stock market is up against top end of its range, but you notice crypto is kind of just floundering here. And actually, Bitcoin, all it did was it just rallied up against that double top. Remember, we said there was an inside bar failure there. And now we're just sort of floundering here, just kind of going sideways right at the original breakdown level. Also, too, now I'm not quite sure how this plays out, but it is an interesting anecdote. Litecoin as sort of a leading indicator of late, he's kind of broken down a little bit, and that's probably where the sort of crypto top 30 starts to break down. But notice how Ethereum, I was a bit surprised to see how Ethereum is relatively strong here, and it's basically right back up testing its high end of range. Do we just go sideways through the weekend here, given crypto seems to be following the stock market's lead here of late? Kind of like that thinking. And frankly speaking, looking at this chart, I really don't have a problem hopping off this long. That's an inside bar fail. And if anything, I wouldn't mind. We just calm down here, maybe paint a new like 3-bar fractal bottom, something along those lines. Maybe even like one low, higher low, second higher low, third higher low. Give me a bullish bot. And then this turns back up and I'll just jump right back in. Basically, I bought here and I sold here. I mean, it's just basically a scratch trade. It's not that big of a deal. As for individual ideas in the stock market, I do see somebody over there on YouTube. We'll probably finish off with this kind of thought. If we look at a stock like Apple, I think that there's just an absolutely beautiful trade up here. And it's so funny when these trades come in because this was damn difficult to take. I had like nice 3-to-1 risk reward on a test of these lows come in. Then just sideways, 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 and then, further continuation. I still like the idea of us heading down to things like 50% retracements of this entire. So there's the base on Apple. There's the top. So there's 50% level. I still like this as a downside objective into that first quarter of the year. I actually think that Apple is actually pretty closely aligned with what's going on the ground in China. And if it's chaos there, then there's probably going to be chaos in in what's that called? Foxconn, that big factory that they have over there. And what's really weird, what's going on in China right now, I mean, you go to hospitals, you can't even get a hospital bed. And it's chaos there, right? It's no beds, no respiratory machines, no medical equipment. There's just nothing there. So it's almost like, China's going to find out natural immunity pretty damn quick. And what I found interesting, young people are self-infecting themselves. This is getting just chaotic. Must be celestial events. Too bad, actually, Cole was going to come on the show today and talk celestial stuff with us. But I think that the Apples and the Teslas and all that kind of stuff, I think they're all sort of playing off of this insanity, what's going over there. Maybe if we're lucky, this just blows over and, a whole bunch of people get sick, a whole bunch of people pass away, whatever. Oh, by the way, if you're on the site and you'd like to ask some questions for the after hours video call, put your questions on here. I think Chris did put this document in the lounge. So anyway, just to finish off this thought, somebody was just sort of asking, what do you think of Apple? What do you think of Tesla and all that kind of fun stuff? I certainly don't think this is a buy, and I think these stories are over. It's just a question of, does this kind of look oversold? Willie's stupid, right? So that in itself should tell you it's probably way too late to be a seller of this. You can see cute little W's are trying to come in on RSI. I have a rule that really you want to take the second W. The first W, this is just to stop out the late bears. And you look at the price of this asset. Could we jump right back up? You can see there's a big old gap on this chart up at 142. So here we are at 127. Could you see that kind of rally? Sure. Is that the kind of rally that actually produces this sort of ranging market where, these kind of dead cat bounce rallies actually bring the whole stock market back to unchanged? Now, it's interesting that this sort of brick and mortar kind of companies have already done that to a certain degree, but I wouldn't be surprised if NASDAQ has a bit of a rally. And that's one of the reasons why the stock market actually comes right back up to the top end of its range. And I'll finish off with just a quick boo at Tesla. Sort of, it should look very similar to what we were saying there about Apple. And again, I think these are yesterday's stories. If anything, the kind of stocks that I like soybeans. If you listen to Mr. Williams, he made a really interesting pitch on soybeans. And sort of what soybeans like to do decade in, decade out. Could this Tesla's name actually be at downside objectives? Maybe. I mean, we always say, in Bitcoin, if Bitcoin price corrects 70 to 80%, usually 80%, it's like a no-brainer buy. So you can see where we are coming down to the bottom end of the range here. Could you get a dead cat bounce here? Sure. Is this the kind of thing where I'd entertain the idea, okay, it's time to invest in this thing? No, I think this is yesterday's story. And what I did hear yesterday, which was really interesting, was the Consumer Electronics Show is going on in Nevada right now. It's the first one that they've done in like 2 or 3 years because of the COVID crap. And it's an absolute chaos there. But more importantly, they were saying that more than half of the exhibitors at the conference were EV related names. So EVs and all this kind of stuff, this is yesterday's story. This is not tomorrow's story. The space is now going to be completely diluted with a bazillion different competitors. And frankly speaking, I think Mr. Allen, he's off in Twitterland, and he's off boring holes underneath LA, and he's off flying spaceships around the solar system. I don't think he's even the slightest bit interested in Tesla anymore, ironically enough. This is yesterday's story. Could you have a dead cat bounce and this is actually established a trading range and you get 38.2? Sure. I mean, you see there's a big old honking gap up top here. But in my opinion, this is yesterday's news. This is not something you really want to invest in for tomorrow. So anyway, that's my 2 cents there. Okay, that's about a half hour, 40 minutes, somewhere in there. Individual cryptos still looking okay. I don't have a lot of breakdown. Interesting thing is our breakdown came in on the crypto top 30. Didn't come in on the broader market crypto space. So I do find that a bit interesting. So my little sushi name still hanging in there. See, Uni's back up into sort of, where it tried to reverse. Matic is holding on to its lows. Chain's holding on to its lows. I don't know. Maybe we go flipping back over into bull mode here. I will say that I do like following this algo and the trading model that I have of late has just simply told me, Brian, with regard to Bitcoin, just hop off on the sidelines based on the DI's breadth indicator reading, wherever the heck that is. Maybe it was this one. Yeah, here we are. So I think especially with the fact that there's a big fat M in there, I think until this thing sort of settles down and starts spitting out W's and higher highs and higher lows and kind of stuff, probably just going to be cooling my jets in crypto land. The broader crypto market still looks relatively okay. But for the purposes of my trading plan here and that Bitcoin position, I'm back on the sidelines. No big deal. Okay, think I'll leave it at that. Slow and steady wins the race. PMA for the win. All the best. Stick around for the after party show. And we'll dig a little deeper into some of the topics that we talked about here today. All right, everybody. Have yourselves a great weekend. PMA for the win. All the best. And bye for now.